Welcome back to Open Exchange West Africa. According to a recent report by Samir Gadio, emerging market strategist at Standard Bank, Nigeria's Naira resilience underpins carry trade, calling for Central Bank of Nigeria's need to maintain a broadly attractive rate regime to attract portfolio inflows while ensuring there is an incentive to hold Naira assets domestically. Let's now cross over to our London studios for more with Samir. Thank you so much, Samir, for your time.
Morning.
Well, let's just start off with this cash reserve requirement from the last MPC meeting. That really hasn't had any effect on the Nigerian yield curve. But you say in your report that another CRR tightening is likely. Could you just tell us why you think so?
Well, basically, first of all, the impact has been muted because we haven't had any new open market operations for some time. And so, yes, there was a withdrawal of liquidity, but at the same time, you had more redemptions, which somewhat supported the overall liquidity positions. And we still feel that the central bank is likely to increase the CRR on public sector funds because, well, first of all, the impact of the 50% CRR on public sector funds has been somewhat mixed, but also because they want to achieve the same results that the single treasury account reform would bring. And basically, increasing the CRR on public sector funds to 100% would kind of achieve the same outcome, but through the back door.
Now, why do you recommend the 6 to 12-month carry trade, which you say carries more value?
Well, the issue at the long end at the moment is that we have limited capital inflows and pension funds don't see value in bonds below 13%. So actually for bonds, the range of trading is 13 to probably 13.8%. While actually at the short end, your duration risk is very marginal at the moment. At the same time, basically, Nigeria offers yields much higher than what you could get in other emerging markets. And you have a currency which is stable, well, relatively stable despite the pressure that we've seen recently, at least versus EM currencies. And we know that the exchange rate is policy determined. The central bank is likely to do everything possible to have a relatively sustainable FX framework, at least until Governor Sanusi leaves in June 2014. So the risks to the currency are very limited and you get a very decent yield at a 6 to 12-month portion of the curve. I think it's quite a decent trade.
Now, let's talk about the currency. You say obviously it's been stable at around 161 now, but with that from the last MPC meeting and the CRR, I suppose the central bank was hoping that the Naira would trade below that, perhaps somewhere around 159 to 160. But you say that it's still better compared to other emerging market currencies.
Yes, I mean, other emerging market currencies have lost ground against the dollar more significantly, and that's because most of the time they are somewhat more floating currencies, while actually the Naira to some extent is heavily managed. But I mean, the CRR on public sector funds had a limited impact on the currency just because, as I said, we didn't have any new OMOs. And then on top of that, actually, when you look at foreign capital inflows, they haven't actually resumed. So in a sense, it's difficult for the currency to appreciate until those meaningful flows, for example, in line with what we saw in 2012, resume. And that's not likely in the very short term, given the current environment globally. However, the central bank still has $46.9 billion of foreign reserves. And so it can support the market via the WDAS or by selling dollars directly to the banks. And it can tighten liquidity further in coming months. So it's difficult to see how really the exchange rate is going to break, especially given the high oil price at the moment. To me, it seems that this level, that is 160-ish, is going to be sustainable until early next year, at least.
All right, thank you so much, Samir. We're going to have to leave it there. Thank you so much. Samir Gadio, emerging market strategist at Standard Bank.